I think, the pertinent question here, does debt really matter? So this is the $245 trillion question. So joining me here today, as we've just heard, four very distinguished panelists. I'm not going to spend time introducing folks. You've got all that information with you. But in Claire, Gilles, Laurie, and Jason, we have a banker, an economist, an investor, and a former policymaker who's now in academia. So we've got all the bases covered for a pertinent discussion around the issues of debt. My job is just to set the scene, ask a few questions, but I would definitely encourage you to submit questions as well. I've got this handy-dandy iPad beside me, which I can use to pose questions to the panelists, so please feel free to submit them. So in terms of setting the scene a bit, I'll just pull out a couple of numbers without going over the top. The rounded number for global debt, and these are IIF numbers. They do a very good job of pulling together global debt statistics. So as I mentioned, 245 trillion, 320% of global GDP. The split between developed markets and emerging markets, kind of 70-30. In developed markets, the biggest increases in debt have really been in government debt over the last decade. More recently, that has been a U.S. phenomenon rather than a European or Japanese phenomenon. In emerging markets, the debt increase has really been in the corporate sector. It's not just China. And in China, we're all aware of the corporate debt issues or challenges or problems in China. Debt in China, corporate debt up by 400% over the last decade, around 21 trillion now. There may be some issues around classification, whether that's corporate or not. But even so, if you look at other emerging markets, you see increases in corporate debt as well. Chile, India, Indonesia, Lebanon, Pakistan, Philippines, Saudi, UAE. So across different geographies and different rating levels. So in overly simplistic terms, if you look at developed markets, it's a government debt problem. In emerging markets, it's a corporate debt problem. That's, again, an oversimplification. So in talking about these, what all of this means and does it really matter, I propose to kind of focus on three broad areas. Talk about debt from a policy perspective, talk about debt from a markets perspective, and talk about debt from a financial stability perspective. So, Jason, I wanted to start with you because it could be argued that the world's biggest debt problem is right here in the United States and begins right here in Washington, D.C. Government debt, $21 trillion. So $1 out of every $3 that's owed by a government somewhere in the world is owed by the U.S. government. It's an awfully big number. You've written a somewhat, I would say, slightly provocative piece in Foreign Affairs entitled, "Who's Afraid of Budget Deficits?" And I'll try to paraphrase. If I get it wrong, please correct me. And you say the focus of policymakers should really be on social problems, not necessarily on deficits, but deficits can't go on forever. So why not worry about deficits when they're in the order of $1 trillion a year, and that debt stock at 21 goes up by $1 trillion a year? Isn't that a big enough number that we should be worried about it?
Great. Thanks for the question, and thanks for mentioning that piece, which I think you described as slightly provocative. I wrote it with Larry Summers. My draft was just very, very, very slightly provocative. His draft was provocative, and it averaged out to slightly. I think I'm tempted to say this time is different, but you always get in trouble when you say that. But there's a lot of different conversations going on in different rooms in D.C. right now in this center today. Some rooms, people are worried that interest rates have been too low for too long. Some rooms, they're worried about buildup of risks in the financial sector. Some rooms, they're worried about what the scope for monetary policy is going to be to deal with the next recession. Every one of those worries would be even worse right now were the United States and some of the other advanced economies to have much lower levels of debt. If we took 2 percentage points off the global equilibrium interest rate by being at the debt levels we were at 15 years ago instead of where we are now, I don't shudder to think what monetary policy would be like, what the reach for yield risks in the financial system, and all of that. When the facts change, you need to change your views. When I was in the Clinton administration, we were on course to fully pay off the debt in a decade. At the time, real interest rates were 4.3%. Today, we're on track to our debt being 100% of GDP in a decade, and real interest rates are about 0.5%. Do I think all of that means, everything's fine, we never need to worry again? Definitely not. I don't want you to overhear what I just said. Interest rates can rise. There's a risk associated with a larger debt. It affects intergenerationally and the like. When it comes to the financial system, though, no one is advocating regulation that would take the probability of a future financial crisis down to zero. You would never say we want 90% capital adequacy ratios because we want a 0% chance of a bank crisis. In financial regulation, we recognize the sort of a balance of risks between growth and safety. I think so too on the fiscal side, we shouldn't think risk should be zero, and especially for large economies borrowing in their own currency, you can overstate them. In terms of where, but if you have no limiting principle, I think you have a problem. So what I would do right now is emphatically not dig the hole any deeper, pay for new tax cuts, pay for new spending increases, don't worsen the underlying baseline deficit. I think, that would be unsustainable and problematic. But I wouldn't make a huge effort towards lowering the debt, even below the baseline. And the last thing I'd say about this is just a political point, that I think some people agree with a certain amount of what I just said analytically, but they're afraid to say it on the theory that if the truth comes out, the political system is so wildly irresponsible, they'll take that truth and run with it to bad places and see this sort of a noble lie where you don't do a balanced assessment of debt risks, but just talk about drowning in a sea of red ink. I think that's wrong. I look at Germany right now, I think they're making a mistake in the opposite direction. The United States made the mistake in the opposite direction a decade ago. I think there are just as many examples now of being overly concerned about debt as there are about being underly concerned about debt, and a clear picture of how the cost of debt varies over time, how it depends on the circumstances that your macroeconomy is in, I think is the best way to chart a reasonable path forward.
But is there some point in the future where the deficit and the debt in the U.S. do need to be addressed? You say you're not worried about the debt path, which, if you use CBO numbers, just shows it on a steady incline, reaching quite high levels. We're at 100, as you said. So if there is an interest in arresting that development, where do you think the solution to that lies on the fiscal side? Is it on the revenue side, or is it on the spending side?
Right. So, first of all, just in terms of just the mathematics of the solution, I said you should pay for everything. If you adopt that standard as including paying for the tax cuts when they expire at the end of 2025 on the individual side, so you pay for any extension or you let the extension lapse, you also address Social Security and address Medicare and do it without then using the savings to double count and pay for two things at once. So you did those three steps, dealt with the extension of the tax cut, Social Security, and Medicare, you'd basically have a sustainable debt. And in some sense, the current budget pay-go rules say you're supposed to do all three of those things. Whether people actually do is another big question. So I think we can sort of almost stay within those rules. What I just said didn't answer your revenue spending question. It gave you the mathematics. I would do it much more on the revenue side. I think spending is already pretty tight, and there's going to be upward pressure from health costs. We should try to moderate that some. But even with moderating that, I don't see how we can do this mostly on the spending side.
Okay, thank you. Lori, as our investor on this panel, you need to think about risks versus returns. And in today's global markets, do you feel that risk is fairly priced? We're talking about massive amounts of debt, but interest rates being very low. So how are you making sort of asset allocation decisions based on this very large stockpile of debt, but very low yields and spreads?
Yeah. So it's not easy out there. It hasn't gotten any easier over the last couple of years. I was Chuck, like I was on a panel a couple of weeks ago, and some of my fellow panelists were saying how hard it was to invest back in 2008 and 2009. I was like, whoa, it was easy. Pretty much anything you bought then was going to go up. You just had to have the fortitude to make the choice. Today, it's not quite that easy. I think there's sort of a good news, bad news here. So First, the good news, right? There's not really any inflation in the world either. So to the degree you can get any kind of positive real return out of your asset classes, there's a benefit to you. Now, inflation may come upon us suddenly. There are certainly pockets where there are vulnerabilities, but from the standpoint of what kind of return you need to achieve to outpace inflation, it's quite a bit lower than it would have been historically. The bad news, though, is, as you note, there's a lot of debt out there with zero interest rates, negative interest rates, even in places where historically you've seen more premia, like high yield, emerging debt. All of those asset classes are yielding, at least in nominal terms, a lot less than we've grown accustomed to. So there are a couple things as an investor you have to think about. How am I going to get income, for sure, in an environment where the rates are so low? That's very difficult to achieve. How am I going to get capital preservation? And there again, it gets to this question of how are we pricing risk, and will default rates go up? And if we have any sort of continued deterioration in the global economic backdrop, what does that do in terms of my capital preservation pool? And then diversification, because here again, once upon a time, you had environments where if the stock market fell dramatically, most likely you were going to get a lot of appreciation out of your bond portfolio. But when you're bumping up against the zero boundary, and even if you can go somewhat negative, clearly the opportunity for capital appreciation is not what it is today versus what it would have been with interest rates somewhat higher than they are. So there are a couple things that we certainly see our clients thinking about. One is going out the duration and the credit spectrum, so things like emerging debt, high yield, but they're again being somewhat more mindful of quality, so you can avoid those kind of rolling exposures to certain industries or countries or other sectors that might be more vulnerable to losses, either through default or other mechanisms. We also are seeing substitution. So how do you think about things like dividend-paying equities? How do you think about other asset classes like REITs or MLPs here in the US or other places where you can get incremental income? The problem with all of those types of alternatives is that they introduce different risk profiles, right? So now all of a sudden, if you bag the eggs, so to speak, and you move into a portfolio of income replacements that aren't the same as the sort of structural credit or fixed income that you might have had in the past, all of a sudden your whole portfolio beta looks different. Your whole drawdown risk looks different. The scenario analysis you have to run, the potential for tracking risk is going to be a lot larger. So what it does require is a lot more heightened vigilance around risk management. So, not a great picture, but ways to put the puzzle together that can get you closer to where you need to be, but then you have to have a lot more infrastructure and ability to sort of think about those outlier scenarios and take precautions or hedge against those.
I mean, do you think you are, as an investor, adequately compensated for risk in some markets? Because when you see Italian yields lower than US yields...
What's kind of interesting is that there are places in the investment grade market that are actually the most troubling, right? So if you look at some of the corporates, for example, these long duration 50-year, 100-year bonds that effectively are giving you no return premium over treasuries, or in some cases even trading through them, which is ridiculous. So I actually think there are vulnerabilities all throughout the credit markets, and it's all about security selection. There are places to get return. You need to be a bit more opportunistic. So I would say in the last couple of years, the amount of sector rotation and asset allocation decision-making, the dynamism around that has been a lot higher, because you do get these periods like fourth quarter 2018 where you get massive sell-offs against a backdrop where you have a hawkish Fed and concerns about global slowdown. That's the time to definitely load up in those sectors where you do see a lot more attractive risk-return premium.
Okay, thank you.
Yeah.
Gilles, talk a little bit about European debt sustainability. I wanted to ask you about that. And how are some of these heavily indebted governments like Italy or Greece, how are they ever going to get out from under this? Or is this just a feature for the medium to long term? Can you walk us through your thoughts there?
Well, my starting point would be that we've spent the last 10 years in Europe basically making our debt sustainable. And we've done it in three different ways. First of all, we've created a number of emergency response mechanisms which are almost natural to us now, which were not back in 2010. But the ESM is here, it's credible, and I think that any bond vigilantes would have learned to their detriment that you don't necessarily go against this massive support system. Second, monetary policy, that's obvious. To some extent, obviously, low inflation in Europe is a reflection of our lack of demand, but it also comes as a blessing, allowing the ECB to make debt profoundly sustainable for some period of time across the curve. The third element, and that goes to the last leg of your question, is on what countries actually did. Because, and I confess myself, I was pretty negative in those days about the possibility for Greece, for instance, to produce the sort of surpluses that were part of the deals. And by and large, they did. And that, for me, is a very positive element, because the difficulty is not so much how to maintain surpluses once you've achieved, actually, those surpluses. The issue is how you go from a primary deficit of -3, -4, -5% to a primary surplus of +3, +4. Once it's done, obviously, you're always one shock away from getting into trouble, but the political cost has been spent. And I think this is where we are. Now, I'm sounding all cheerful all of a sudden, which is not my nature. So there's one element, and one big element, on which we haven't made progress, and certainly not in a country like Italy. It's on trend growth, and that's the big missing link in the European equation. Initially, my view was that we would not see the benefits of the structural reforms as long as fiscal austerity was there. But now that fiscal austerity has basically stopped, it's becoming very, very hard to say, look, this is because of this transitory demand shock that we're not seeing the benefits. So we're probably at a point when we actually need a little bit of extra spending, including in countries which do not have a lot of fiscal space, to restart something with a better quality of spending, especially towards investment. The problem we have is that we may not have a lot of time, in the sense that we can sense that support from the ECB is probably getting close to its end. My reading of the decisions in September is that, folks, that's all. That's all we can do. And if we want to go another notch, you will get into some very, very controversial territory by making basically national central banks the deciding forces in any sovereign restructuring, which probably is a big political problem. So we don't have that much time to finally get this pump priming, this restarting of potential growth. And we might have a very, very small window of opportunity for a grand bargain, basically, in Europe. I think the conversation in Europe is too much centered on whether or not we should move the stance, and it's not enough on the quality of the content of fiscal packages. It's one thing to disagree when some countries, for instance, the periphery, spend too much on transfer programs. I think it's less valid when we're talking about proper public investment programs, proper education initiatives, and so on and so forth. And on this quality of the packages, I think there is maybe narrowly a window of opportunity when we can get Berlin and the other capitals to agree to unleash a little bit of extra spending. Strangely enough, we probably need this extra spending now to make our public debt more sustainable in the future.
Interesting perspective. One thing I wanted to ask you about what you said, I think the words you used for the ESM you described as credible. So what about with Italy? Is Italy too big for the ESM? Would Italy be too big for the ESM?
Italy has always been too big for the ESM. And Italy was... any question starting with Italy to anyone around the ECB would prompt the word OMT. which obviously makes it politically much more complex and much more difficult. But again, if you look at the behavior, the actual fiscal behavior of Italy over the last 15 to 20 years, not much has been squandered. And again, I must confess I was too pessimistic in the last 2 to 3 years. We were on the brink of something pretty uncontrollable a year ago, and by some miracle of Italian institutions, we're probably moving away from the brink. There's a sort of self-stabilizing operation at work here, which seems that every time we're getting close to having to confront the possibility of a crisis, the system reestablishes itself. It's not going to last forever. Again, there's a question of fatigue, especially popular fatigue around all this. But if you look at the very, very dark predictions on politics that we had just a year ago in Europe, actually, this year is not great for populists. Or at least some populists have rediscovered the idea that working with non-populists is sometimes a very nice way to stay in power.
Okay, thank you. Claire, to you. What are you telling Morgan Stanley clients in this who are looking for funding in this kind of environment? Rates at these levels, is it just an across-the-board idea, borrow as much as possible while you can, or is the message a little more nuanced than that?
Well, your average corporate treasurer is really quite a prudent person. They're a control person. They work for the CFO. Look, you're looking at, low interest rates, flattening yield curve. So, if you're going to extend your financing, you're going to want to take advantage of duration. So you're not particularly worried about debt service, assuming that you're working in an organization that's got a sustainable business model. And so, if I'm the corporate treasurer, why wouldn't I take advantage of, current, market terms? And if you look at, the syndications, most good quality credits, and Gloria's absolutely right about credit profile, these deals are oversubscribed. So I'm absolutely going to be thinking forward about my investment opportunities and what I want to do to service the business. But I'm absolutely going to be accessing the market with terms that are available at the moment. And, investors are there and absolutely underwriting deals. In terms of covenants, etc., it's never been better for borrowers and corporates. So it's a good time if you need to refinance.
Is that a bit of a ticking time bomb, that covenants being as friendly as they are?
Well, we've been talking a lot about sort of dilution of maintenance covenants and just generally the sort of covenant-like deals, but we're still seeing those terms, be underwritten by investors. So, but obviously our credit committees crawl all over them for sure.
Okay. We've got a couple of questions in from the audience, and I'm going to pose one to you, Jason. Ray Dalio talks about beautiful debt deleveraging, and that's in quotes, so it must be something he's written. Being hard to do. How do we deleverage without having a deflationary impact? Is that possible?
I think we don't worry too much on the public side about deleveraging. We just worry about, over releveraging, that we stay on, we don't add to as I was saying before, we don't add to the problem. We don't do, one of the presidential candidates, somebody added up all of his proposals and they added up to $97 trillion over the next decade. I'm willing to go out on a limb and say maybe we shouldn't do $97 trillion. I'd even say we shouldn't do $9.7 trillion. While 970 billion, now we're at 1/100th of what Bernie Sanders has proposed. 970 billion isn't going to break any apple carts. Even that, it's sort of easier to draw a line at zero than to pick other gradations of numbers. But we have slowing growth right now. We have central banks easing policy. We don't know quite where the recession is, but there's one out there around some corner. This doesn't seem like a good time to worry about deleveraging, at least on the public side.
Okay. I wanted to talk a little bit about a financial stability risk, and maybe Gilles and Claire talk to you about that, thinking about banks and insurance companies struggling with net interest margins. Are we getting closer to a time where we need to genuinely think about financial stability risks in this regard?
Well, shall I say a couple of words and then Gilles, you can comment. Post-crisis, we were worried about the concentration of risk in banks, and the whole point was, the risk should be much more distributed, which is what you've seen. And actually, if you look at bank balance sheets, they're much cleaner now than they were, post-crisis. So the risk has definitely been distributed across the system. Whether that poses a financial stability risk is another question. I'm not sure that it does, but that was absolutely one of the key concerns post the crisis, and the risk has absolutely been distributed. Do investors understand what they bought? We like to believe that the disclosures are all there, and buyer beware, and much more so now than pre-crisis. So I think there's been a much better distribution of risk, and I don't know that creates a financial stability risk.
Yeah, to talk about financial stability, you need to think in terms of catalysts, trying to find the catalyst that would turn the current situation into something nasty, and to some extent, primarily because of what central banks have been doing and are doing, it's very hard to find this catalyst. And where we might have reached counterproductive territory, it's in the sense that we are allowing a number of corporates in Europe, for instance, to survive. We are impairing the creative destruction process. But it's very easy for me to say that, on a nice day in Washington, D.C., that we should allow our corporates to go bust for the sake of productivity, growth enhancement. But to some extent, we've stopped. We've killed this pipeline of risk for a while. Second, in terms of our reaction as investors, from a very microeconomic point of view, you could say, look, you can do something else. So if you're an insurance company, it's the case for AXA, for instance, you start focusing a bit more on P&C, and you move out a little bit, or you change a bit your mix to be a bit less sensitive to the interest rate risk. More importantly, I think, we probably have to think about regulation. In the sense that when, for instance, Solvency II was negotiated, I don't think that many negotiators believed that we would be in a state of negative rates. And it's a regulation which is in its infancy in reality. It's 3 years old in terms of implementation. Some aspects we are discovering today are procyclical, and there is probably some good case for some fine-tuning there on regulation, so that to avoid more of the counterproductive effect of low interest rates.
Okay. It's all very doom and gloom when we talk about debt. Laurie, where does ESG kind of fit into maybe the mandates that you're looking after at State Street amidst all this kind of doom and gloom talk? Is there a positive story? Is there a slightly more positive story about investing to support ESG principles? Is that on your radar screen?
So in the fixed income realm, ESG is a multi-headed hydra, because on the one hand, those projects or those companies that are able to, invest in green technologies or leverage financing, they can get better cost of capital, right? So we've actually seen investors willing to pay a premium to get ESG-friendly green bonds, things of that nature, into their portfolio. So in that sense, it's a benefit to those companies or those entities that can, access pools of capital at much better cost of capital. The other side of it, though, is that there are major industries and large borrowers in the manufacturing and the oil and gas and utilities and other sectors that are huge issuers of debt that are confronted with the potential for stranded assets, the transition costs associated with regulation. So they're not issuing ESG bonds. Their normal debt is potentially under siege in an environment where many of their assets may not be productive capital inputs in the future. So I think this is one of those issues issues that it's still kind of early days in terms of understanding what the longer term ramifications are, because as we all know, most of us think in terms of the ability and capacity to pay. Debt tends to be relatively shorter durated than some of these longer term climate disruptions might, create. So you're talking 3, 5, 7, 10 years, not 50 years. But bear no mistake, there will come a point in time where the reckoning will come for a lot of these companies where the deterioration in their credit quality and the awareness of their ongoing degradation of their capacity to pay will become under threat. So ESG is sort of a bunch of different things from a fixed income vantage point.
I get the sense that one of the other terms that people are using means a bunch of different things to different people as well, which is this idea of Japanification. Which I think, well, I'm not really sure what it means, but like to just kind of throw it open to you guys. Who, what do you understand that term to mean? Typically, people suggest it's pretty negative. We don't want to have Japanification. It's like a threat. Everything's going to go horribly wrong. But in many respects, Japan doesn't look that bad, right? If you look at per capita income growth, it's not really that different from the U.S. Over the last decade or so. So is this a bit of an empty threat, this whole Japanification story, or is there something we should be concerned about?
So I think the most important fact for people to know is precisely that one you just said, that their productivity growth or their per capita income growth is similar to that of other advanced economies. But I think the second thing is that the overall growth rate, does matter, including population growth. It matters for, how large an adjustment you need to make on the fiscal side, how higher rate of return you can have for pay-as-you-go programs. There's some evidence that, an increasingly aging population is also going to result in lower productivity growth. And there's a number of papers that have found that. So I think, in some respects, Japan is a warning, but the warning is mostly about demography. And the solutions to that are, get a larger fraction of your population to work. They do that quite well in Japan. We could do that a lot better here in the United States. Some European countries could as well. Number 2, bring a lot more immigrants in. That's obviously something they don't do at all in Japan. It's more controversial than it should be in the United States and around the world. And, number 3 is the one that takes the longest time, is to have more children. And, if we
It only takes 9 months. It doesn't take that long.
You have to get them into the workforce too. So I think their demography is a warning for all of us, but not quite the warning that people think.
I would just like to add, though, when I think about Japanification, it's this idea that you don't have enough organic growth, right? That you're trying to stimulate growth, and the way that you're trying to do that is either through some combination of fiscal stimulus, monetary stimulus, like using whatever tools are at your disposal to try to get inflation, to try to get some growth. And against the backdrop, as you rightly said, where demographics there are very poor in Japan, and there hasn't been kind of an open market policy to embrace immigration, although they're trying to do some of that right now. You just don't have a lot of levers. So the challenge becomes, is that going to be what Europe looks like? Because Europe is growing old pretty rapidly also. Is that what the U.S. is going to look like? The U.S. has benefited from immigration, higher birth rates, things of that nature historically, but against an environment where those levers aren't available. So then what's left, right? If you don't have the ability to grow your economy in the kind of traditional sense through productivity or population growth or things of that nature, then all that's left are the monetary and fiscal policies, and there's potentially a limit to those. Maybe we certainly haven't seen the limit yet in Japan, but at some point there's a limit to those things.
Sure. Yeah, there's one aspect of Japanification which is central to me. It's the fact that as a society, Japan has accepted the notion that you merge the balance sheet of the government with the balance sheet of the central bank, and it's fine. Mm-hmm. And everyone is perfectly okay with this, and it has proved to be financially viable and sustainable for now. And there is nothing in the institutional setup of Japan that has actually made this impossible. I don't know if it would be a political possibility in the US, but same thing, it might not be institutionally impossible. in Europe, getting to that level of merging those two balance sheets, then we are in trouble. And this is precisely what is likely to be at the heart of the conversations at the ECB in 2020, because that famous limit of 33% is actually, for me, the threshold for proper Japanification, ensuring any government in Europe against any accident, because restructuring in the end would be stopped by the central banks. Are we ready politically? Do we have the level of homogeneity, socially and politically, to agree to this? Probably not. Hence my obsession with time, with this idea that we have a window of opportunity to try to sort out our issues. We have a few, probably still have a few years. But betting on replicating in Europe what has been a central feature of sustainability in Japan over the last 15 to 20 years, I don't believe it's correct.
Aren't we already there
No.
in Europe?
No, precisely because you can sense that we may get there, but it's precisely the decision that Mario Draghi did not take, or could not take, chose not to take in September, because the way the latest package was designed is precisely the only package that allowed not to discuss the proper conversation, which is, do we actually make it clear to every investor in the system that we will stand against any sovereign restructuring in Europe?
I mean, I suppose the risky part of this, bringing the central bank and the government's balance sheet together, we haven't really got to the risky part yet, which is take those assets on the central bank balance sheet and draw a line through them and say, actually, you know what, we're just going to write that debt off, so the government balance sheet is stronger, the central bank balance sheet is weaker. Does that matter?
Not really, because in the end, you pay interest to yourself. So if you completely accept the merger of the two balance sheets, you actually don't need to say explicitly that you've cancelled the debt which sits at the central bank. It's fine. You just pay to yourself. The profits go back to the government. It can last for quite some time.
And it only matters if it stimulates rampant inflation, right? And this is the whole MMT, helicopter money. Like, all these things are ultimately some version of that. And as long as there's no inflation, you could argue it's sort of benign and doesn't really matter. The challenge is, at some point, it matters. And when it does, it's a disaster.
So a central bank balance sheet with only liabilities and no assets is okay.
Well, the assets are the future taxing power of the fiscal authority, right? So it's not like there are no assets. They're sitting in this room and around the country and around the world.
Okay. I wanted to talk a little bit about market liquidity and ask Claire and Laurie from your perspective. Is this a real problem? I mean, I'm not in the market, so it's not my place to say. I mean, bond markets are bigger, but you hear a lot of discussion around intermediaries being less incentivized to provide liquidity to traders and investors. And is that an oversimplification? Is it a challenge? How do we think about these issues?
Well, look, there's definitely liquidity and there's definitely lots of cash out there. I mean, what we have seen in the past, 9 months is that, when there's market volatility, you can see bouts of very, thin liquidity. And so you need to be very thoughtful and proactive about how you're refinancing. But I will go back to the previous discussion that we were just having. In this environment of low interest rates, I mean, the key thing I think for Europe is that when governments are able to, take advantage of these low financing terms, what they absolutely need to do is make sure that they're investing the proceeds into projects and investments that are actually going to help the economy and help redistribute wealth. And that's absolutely the key piece that needs to happen. But no, there's absolutely plenty of cash out there, but it's very focused on real sustainable growth and businesses that are, viable over the long term. Laurie, what do you see?
No, absolutely. We haven't seen any challenges with liquidity in general, right? So there was a lot of concern when you had more banking regulation, when you took out sort of the intermediaries that were sort of position trading and such, that might lead to dampening liquidity. And in fact, quite the opposite has manifested for the most part, right? You've actually seen spreads tighten, you've seen depth in markets, et cetera. But when you get hot spots, and you get sort of massive capital outflows from an asset class. And again, I take the fall of 2018 as just a small microcosm of that. Very quickly, that liquidity dries up. So to me, it's less about is there enough, kind of liquidity in the system, and more about are there now systemic bets that asset owners en masse are positioning for, and when you get everybody kind of running for the door at the same time, there's no backstop. But you know what? The old liquidity regimes wouldn't have solved that problem either. So I don't think we're necessarily in a worse case scenario than we were before all the regulations came into effect. But it's just being highlighted because I think there's more and more capital that's trading with similar kinds of risk analyses, risk awareness, and positioning.
Okay. So Jason, we have the proposition that central bank balance sheets, it doesn't really matter if they don't have any assets, or that the assets are debt that'll never be repaid. What are your thoughts on this?
I think you just need to look. I agree. I think you need to look at the underlying macroeconomic situation. And if you're doing that in a way that is, producing systematically above your potential with rising inflation, that's a recipe for really big problems. If you're doing that as part of a strategy to remedy what appears to be, chronically insufficient demand, then I think it's a perfectly fine thing to do. I think all of this, ultimately it is all the government's balance sheet. The fact that you pretend that it's not is a sort of useful way of placing some type of limit on what you're doing in terms of macroeconomic and fiscal policy. I think some places may need that useful type of limit, but you don't want, to have that limit inhibit you from, what you need to do when you need to do it. So I'm certainly glad Japan is, piercing that type of veil, and I'm not particularly worried about debt in Japan.
Negative yielding debt, is this ever going to come to the U.S.?
My guess is not, but I don't know. My guess is not, though, because of, we sort of don't mind the borrowing on the fiscal side. I don't know, when we get to 250% of GDP, I can't quite predict.
Well, we have had negative rates for flashes, right? When we've had increased demand, especially in money markets, so it's not like it couldn't happen, but it's not likely because we do think that the structural growth here in the U.S. is, at least from our vantage point, is high enough to sustain positive interest rates. And
you as an investor, when you're buying negative yielding debt, how do you as an institution think about that? Do you have to hold your nose and buy it anyway?
Well, for the most part, we would avoid it if we can, right? So if you look at the one area that I didn't comment on earlier that's been very unattractive to us for a long time has been sovereign developed market debt, where you've got effectively negative yield. So we have tried to avoid that where possible. If we have to hold it because the client needs to have some exposure to income in their local domicile, and that's sort of the best game in town, you buy it and you put it in the portfolio, but you try to work around as best you can.
Okay, so we only have a couple of minutes left, and I want to just ask each of you if you could think about sort of big issues that you'll be focused on from your perspective over the next year or so. So it's that time of the year where we're starting to do our sort of 2020 outlooks, and everybody's got that in their minds. When you're thinking about your own 2020 outlook from your perspective, and thinking about the things we've been talking about, what would be sort of top of mind? Maybe I'll start with the far end, Claire.
Well, I'm really excited that we have raised over $70 billion for companies, green bonds, sustainable bonds. And I think in this continued low rate environment, I want to see that us really, push the envelope there. There is plenty of investor demand for this. There is not insufficient product, so that will be top of my list.
Perfect. Gilles?
Well, top of my list is really, assuming some of the obvious risks that we've been dealing with do not materialize. Assuming the trade war, to some extent, gets resolved, assuming Brexit, is kind of sorted out.
We nearly got through this entire
I really do
panel.
want-
I was
Quite.
determined not to
Yeah.
mention the B word.
I live in the UK, so
Gilles, I know, but so do I.
I'm a guest in the UK, so it's a bit of an obsession for me. But for me, the interesting lab experiment, if you want, for 2020 is, if you remove them, would it be okay? Or have we reached a point, a sort of acquired speed or lack of speed in the world economy, which would mean that even actually, if we get good news on those two fronts, things would remain quite mediocre. And that's my big question for 2020.
So many things, but I guess I'll go back to corporate earnings, right? Because one of the concerns that we're watching very carefully is, whether the sort of recession, if you will, or mini recession of corporate earnings persists, and that has a lot of dimensionality to it. It's manufacturing sector where trade spats have created a slowdown in capital investment, trade down, slowdown in flows, et cetera. And basically, the U.S. economy has been held up by the consumer this year. We think that can persist because the U.S. consumer is the largest part of the economy, 70% or so, depending upon how you measure it. But at some point, you do need to have some of these other sectors come back into play, and so how corporate earnings play out over the next couple of quarters will be something we'll be watching pretty carefully.
Perfect.
Most economies have been growing above trend for the last 7, 8, 9, 10 years. And we've gotten really used to that above trend growth. Anyone who went through the numbers knew that your unemployment rate can't fall forever, knew that underlying trend growth was really quite low, but a lot of people were sort of letting bits of optimism and lack of analytics get away from them in projecting something more like the above trend growth than the inevitable return to trend. The big question for the next year is, are we seeing a return to that trend in the United States? I think that's about 1.75% growth. And I think a lot of what we've seen is fully consistent, not with trade wars, global slowdown, et cetera, but with some factors on the positive side, like fiscal stimulus, unusually low interest rates, some factors on the negative side, like the trade war and the global slowdown. They're canceling each other out, and we're moving on a glide path towards trend. That's where I'd place most of the probability mass in terms of interpreting the U.S. economy right now. But the crashing through trend, below trend growth is certainly a possibility, and I think the trick is going to be to figure out how much of this is a sort of predictable and predicted slowdown, how much of it is something above and beyond that.
And given that it's an election year in the U.S. next year, are fiscal issues going to be on the radar screen at all? Is there going to be any discussion? Is that, an election discussion point by anyone in the United States?
It's not top of mind for voters, as far as I can tell. I don't quite know how President Trump is going to bring it up for whoever's running against him, and the size of some of the plans on the other side. I'm not quite sure how they're going to bring it up with President Trump, so maybe everyone will stipulate that they won't discuss the debt for the next year and can worry about it at some future date.
But there's two parts of the question, right? There's fiscal on the table, and what are we talking about? Debt, right? I think fiscal is going to be all over the headlines in 2020. Whether we talk about the debt, the sustainability of U.S. debt, probably not.
Fair enough.
Yeah.
Thank you very much. Please join me in thanking our panelists for an interesting discussion. And I believe lunch is coming next, but leave that to our kind host.